Here is a question most people never stop long enough to ask. What happens to your money, your savings, your 401k, your grocery bill, your job, if 20% of all the oil in the world suddenly stops moving? Not a gradual slowdown, a sudden disruption, a choke point closed. That question is not hypothetical anymore. In early 2026, it is the exact question that the most powerful navy on Earth is trying to make sure you never have to answer. And the fact that they are out there in force, in numbers not seen since 2003, tells you something about how real the risk is considered to be. In January 2026, the United States moved its largest naval presence to the Middle East since the invasion of Iraq. We are talking about carrier strike groups, destroyers, attack submarines, the full weight of American military projection. You do not deploy that kind of hardware as a precaution. You deploy it when someone at the highest levels of the national security apparatus looks at the map, looks at the intelligence, and decides that the risk is serious enough to require a visible, overwhelming response. And the focal point of all that risk, the single geography at the center of all this, is a strip of water called the Strait of Hormuz. This video is about what that means for your money. 7 moves, each one grounded in what Warren Buffett has actually done or said directly during previous geopolitical crises. Not theories pulled from financial textbooks, not predictions about oil prices, a practical framework for protecting what you have built, and potentially coming out of this period ahead of the people who did nothing. Buffett has lived through oil shocks, wars, financial panics, and market collapses. He has a playbook. And today, we are going to walk through it together. If understanding how money works during moments of global uncertainty is something you want more of, subscribe to this channel. This is where we break down how the financial machine really operates, in language anyone can understand. Imagine the plumbing in your house. Every faucet, every shower, every appliance that needs water runs through one main pipe coming into your home. Now imagine someone sitting right next to where that pipe enters the building. Hand on the shut-off valve. That is the Strait of Hormuz, not a metaphor for something important. The literal physical shut-off valve for 17 to 20% of all the oil that moves on this planet every single day. That oil travels from Saudi Arabia, Iraq, Kuwait, UAE, and Iran, loaded onto tankers, passing through this 21-mile-wide corridor. And then it goes to Asia, to Europe, to the refineries that produce the fuel your country runs on. When it flows, the system works. When it does not, the system does not. We have seen what happens when that flow gets disrupted. In 1973, the Arab oil embargo cut global supply by roughly 5%, just 5%. Gas prices in the United States quadrupled, GDP dropped, inflation ran into double digits. In 1979, the Iranian Revolution disrupted Persian Gulf output. Oil prices doubled in under a year. In 1990, when Iraq invaded Kuwait and the entire Gulf region looked unstable, oil prices spiked 65% in 3 months. 3 different crises, 3 different causes, one consistent result. The disruption punished every household that was not financially positioned to absorb the shock. Not because they were careless, because they did not know it was coming. Here is what most people miss when they reduce this to a conversation about gas prices. Oil is not just fuel. It is the input cost of almost every physical product made on Earth. Plastics, fertilizers, synthetic fabrics, packaging materials, chemical feedstocks, all petroleum derivatives. When oil prices go up, the cost to manufacture things goes up. The cost to ship those things goes up. The cost to refrigerate them, store them, and deliver them goes up. That feeds directly into the price of everything in your grocery cart, your Amazon order, your utility bill. And then inflation rises, and when inflation rises, the Federal Reserve typically responds by keeping interest rates elevated or raising them further, which means the cost of carrying debt goes up. One choke point, Every corner of your financial life affected in sequence. What makes the January 2026 deployment different from routine military activity is the scale of the signal it sends. The United States does not move its largest naval force to a region in 23 years as a cautious wait-and-see measure. Alongside that deployment, insurance rates for oil tankers operating in the Persian Gulf region have climbed significantly because insurance markets price real risk, not theatrical risk. Shipping companies are already baking elevated cost assumptions into their contracts. The signal is already traveling through the supply chain before a single barrel of oil has been disrupted. And the people who understand how these signals translate into personal finance, those people are already making adjustments. Think about what this actually means at the level of your household. Your grocery bill is not priced by farmers. It is priced by a distribution system that runs on diesel. Your heating costs, your electricity, your internet service, the infrastructure behind all of it has energy costs embedded in it. When those energy costs go up, the companies pass it to you. They always do. And in a scenario where you have a job disruption on top of price increases, because oil shocks historically slow economic activity, and slower economic activity means layoffs, the household that has no buffer, no positioning and no plan is the household that makes desperate decisions under pressure. Desperate decisions almost never lead to good financial outcomes, and that is exactly what these 7 moves are designed to prevent. If you have ever felt like global events were something that happened to your money, not something you could navigate, write in the comments right now, "I make the move." Because that is the shift this video is built around. Understanding what is happening is how you get options. In September 2008, the global financial system was melting down in real time. Banks were failing. Lehman Brothers had just collapsed. The Dow was losing hundreds of points per day. The average investor was frozen, or selling at the worst possible moment, locking in losses on the way down. That same week, Warren Buffett wrote a $5 billion check to Goldman Sachs in the form of convertible preferred shares, paying 10% annually. Days later, another $3 billion to General Electric on similar terms. Total deployed during that crisis window, somewhere north of $15 billion. He did not do it because he knew the exact day the market would bottom. He did it because the prices were right, the businesses were sound, and he had the cash ready. Look at what happened during the Gulf War in 1990. Oil prices spiked, the stock market dropped. Fear was real and widespread. Buffett did not sell. He held his positions. He bought more of the companies he understood that had become temporarily cheaper because of the panic. Not because the businesses had deteriorated, but because sentiment had deteriorated. That gap between price and value is what Buffett has spent his entire career hunting. Crises do not create that gap occasionally. Crises are the primary engine that creates that gap. And the people who have cash, clarity, and a framework when the gap appears are the ones who benefit. Be fearful when others are greedy and greedy when others are fearful. That quote gets printed on mugs and motivational posters, but almost nobody actually applies it. Because applying it is terrifying. In 2008, being greedy meant writing billion-dollar checks when every financial commentator in the country was talking about systemic collapse. In 2001, after September 11th, Buffett watched the markets reopen and held his positions while others sold. In 1990, the same. The thesis never changed. Short-term fear creates long-term opportunity, but only for the people who are positioned to act on it rather than react to it. That is not bravery. That is preparation. Here is the thing that almost nobody mentions when they talk about Buffett's crisis performance. He was not responding to 2008 in 2008. He had been building the cash reserves, the watch list, the discipline, and the process for years before the crisis hit. When Lehman fell, Buffett did not scramble. He executed a plan he had already constructed in advance. That is the actual lesson. Not that he is smarter than everyone else, not that he has better information. That he prepares when the world is calm, so that he can act clearly when the world is not. These 7 moves are that kind of preparation, applied to your situation, not his. So let us go through them, not in the abstract, with specific, actionable language, starting with the one most people skip entirely because it feels too basic, and then deeply regret when the crisis is already unfolding. If this breakdown is giving you a clearer picture of how to think about your money during a moment like this, hit the like button. It helps more people find this content at the right time. As of late 2024, Berkshire Hathaway was sitting on $325 billion in cash and short-term government securities. That is not a number Buffett stumbled into. It reflects a principle he has stated consistently for decades. Berkshire will always hold enough liquidity to act on major opportunities and withstand severe economic shocks without needing to sell anything. He once wrote in his shareholder letter that he would never allow Berkshire to drop below $30 billion in liquidity under any scenario. The reason is simple. The worst position during a crisis is being a forced seller. When you have to raise cash by selling assets, you sell at the worst possible prices, at the worst possible time, to buyers who know you have no choice. You end up funding their opportunity at your own expense. For you, this principle translates into one specific, non-negotiable action, a 6-month emergency fund, not a vague intention to have some savings, not a 3-month fund that covers the easy scenarios, 6 actual months of real living expenses, rent or mortgage, food, utilities, transportation, insurance, minimum debt payments, held in cash, untouched, reserved exclusively for the scenario where an oil shock-driven inflation surge combined with an economic slowdown disrupts your income. Medical emergencies, layoffs, business slow periods, the function of the fund is the same for all of them. It buys you time to make decisions clearly, without the gun of financial desperation pressed to your head. And here is where most people do it wrong. They build this fund, which is already an achievement, and then leave it sitting in a regular checking or savings account earning 0.1% or 0.2% while inflation erodes its value every single month. During 2024 and into 2025, high-yield savings accounts at online banks were paying between 4 and 5% annually. Some money market funds were even higher. Treasury bills, the short-term government bonds that Buffett himself uses for Berkshire's cash reserves, were yielding comparable numbers. Your emergency fund has one job while it waits: not lose ground to inflation. Put it in a vehicle that pays you to hold it. A few hours of research and one account transfer can add hundreds of dollars per year to money you were never going to invest anyway. Now here is something you need to pay attention to because it changes the math entirely. Run the crisis scenario in your head. Oil prices spike 40 or 50%. Your grocery bill goes up. Your heating costs go up. Your commute gets more expensive. The Federal Reserve, fighting the inflation that the oil shock is feeding, keeps interest rates elevated or raises them further. The company you work for, dealing with higher input costs across their entire supply chain, starts looking for places to cut. Your income gets disrupted, not necessarily eliminated, but disrupted. The household with a 6-month buffer navigates that period. They make calm, strategic decisions. They do not sell investments at the bottom to cover rent. They do not go into high-interest debt to cover a gap month. The household without the buffer makes every decision under pressure. Pressure and good financial decisions rarely coexist. By 2024, Warren Buffett had built one of the largest energy positions in Berkshire's history. His stake in Chevron sat at roughly $19 to $20 billion. His ownership of Occidental Petroleum had grown to over 28% of the entire company. more than $15 billion at peak valuations. He also held significant positions in energy infrastructure. These are not small exploratory bets. These are among the largest concentrated positions Berkshire has held in recent years, and the timing building these positions as geopolitical tension in the Persian Gulf region escalated over multiple years was not accidental. If you have been trying to build a financial position that can actually handle moments like this, not just survive them, but come out ahead, there is something waiting for you in the first pinned comment below this video. It is built for people who are ready to stop just learning and start moving. Here is the direct relationship that makes energy stocks behave differently than the rest of the market during a geopolitical oil supply crisis. When the risk to the Strait of Hormuz increases, when it looks like the flow of Persian Gulf oil could be disrupted, oil prices go up, or at least the expectation of higher prices is priced in. When oil prices go up, the companies that extract, refine, and distribute oil make significantly more money. More revenue, higher profits, stronger stock prices. Meanwhile, the rest of the market tends to drop, because rising energy costs hurt almost every other sector's margins, slow consumer spending, and increase inflation anxiety. So, in the specific scenario we are discussing, energy stocks often move in the opposite direction of a general fear-driven market decline. They are not recession-proof. But in a geopolitical supply shock specifically, the correlation tends to be your friend if you're on the right side of it. Now I hear people say, I am not going to put my savings into individual oil company stocks. I do not know how to evaluate Chevron's balance sheet or Occidental's hedging strategy or what the current break-even price per barrel is. And honestly, you do not need to. Exchange-traded funds, ETFs, that track the energy sector broadly give you exposure to a basket of energy companies for a fraction of a % in annual fees. A fund like XLE covers the largest U.S. energy companies. VDE covers a similarly broad group. You are not betting your financial future on any single company surviving or thriving. You are making a structural observation that you currently have zero energy exposure, while a specific, documented energy supply risk is elevated, and correcting that imbalance in a diversified, low-cost way. This is not market timing. It is important to be clear about that because the distinction matters. Market timing means trying to predict the exact moment to buy and sell based on short-term price movements. Almost nobody does that successfully over a long period. What we are talking about is structural alignment. Recognizing that your portfolio was assembled without any consideration of this specific category of risk, and intentionally adding a layer that addresses it. Buffett does not predict. He identifies businesses he wants to own at prices he considers reasonable and holds them for long periods. The question you are asking is simpler. Do I have any exposure to the sector that historically benefits from the exact risk I am watching unfold? If the answer is no, that is a structural gap worth closing. During the 1973 Arab oil embargo, as supply fell and prices quadrupled, gold rose approximately 170% over the following 2 years. During the 1979 Iranian Revolution and the resulting oil shock, gold gained over 120% in 12 months. Those are not coincidences looking for an explanation. They are the same mechanism playing out twice. When oil prices spike, inflation expectations rise. When inflation expectations rise, investors look for assets that hold their value outside of paper currency. Assets that central banks cannot print more of when they need to cover their deficits. Gold has served that function for most of recorded human history. That historical role does not disappear because brokerage accounts look different now. Silver follows a similar pattern, but with significantly more volatility in both directions. The upside can be larger than gold during a genuine inflation shock, but the downside during a risk-off correction is also steeper. What makes silver distinct in this context is that it serves a dual function. It is both an inflation hedge and an industrial input material. Silver is used in solar panels, electronics, semiconductors, and medical equipment. That means it benefits from two forces simultaneously during a supply disruption: the inflation hedge demand and actual industrial demand from manufacturing. It is not a substitute for gold in a crisis portfolio. It is a smaller, higher beta satellite position around a core gold allocation. Honestly, here is where this gets interesting, because Buffett's actual view on gold is the opposite of what most people expect from a crisis survival guide. He does not like it. He has said so many times across multiple shareholder letters and interviews. His line, "Gold just sits there, it does not produce earnings, it does not compound, it does not pay dividends." Over any 30-year period, a diversified portfolio of productive businesses has significantly outperformed gold as a store of value. He would rather own a farm, a company, a pipeline, something that creates output. And he is correct about that comparison for long-term wealth building. But in 2020, one of the most uncertain economic periods of the modern era, Berkshire disclosed a position in Barrick Gold, one of the world's largest gold mining companies. The lesson is not that gold is always the right answer. The lesson is that even someone who dislikes gold as an investment acknowledges its specific function during a specific type of uncertainty. For most people, the right framework is to treat gold and silver as the seatbelt in your financial vehicle, not the engine. You do not buy a car hoping you will need the seatbelt. You put it on because the risk of not having it is not worth tolerating. A 5 to 10% allocation, a slice of a portfolio specifically designated as an inflation and crisis hedge, is not an aggressive position. It is a structural acknowledgement that the scenario we are watching develop is exactly the kind of scenario that historically rewards having that layer in place. 5% of a $50,000 portfolio is $2,500. That is the insurance premium. The rest of the portfolio can continue doing what it was doing before. Here is the chain reaction that most people do not trace all the way through when they see an oil price spike. The oil price goes up. That feeds into the cost of manufacturing and shipping almost everything, which feeds into consumer prices. Inflation rises. The Federal Reserve, whose mandate includes keeping inflation under control, responds by keeping interest rates elevated or raising them. And when interest rates rise, the cost of variable rate debt goes up with them. Your credit card rate, your home equity line of credit, any adjustable rate loan you are carrying. The average credit card interest rate in the United States in 2024 was sitting between 22 and 25% annually. If a rate environment driven by oil shock inflation pushes that 2 or 3 points higher, you are not talking about a small number. On a $5,000 balance, the difference between 24 and 27% is over $150 per year in unnecessary interest that you paid while things got more expensive everywhere else. Buffett and Charlie Munger have both been consistent and unambiguous about consumer debt for decades. Munger once observed that the surest path to financial destruction he had ever seen was carrying high-interest consumer debt while simultaneously trying to build wealth. And Buffett has explained the underlying math in simple terms. The interest rate you pay on debt is a guaranteed return in reverse. If your credit card charges 24%, paying off that balance is the financial equivalent of finding a guaranteed 24% investment, which does not exist anywhere else. Not in the stock market, not in Berkshire shares, not in oil ETFs, not in gold. The single highest return financial move available to a person with high interest debt is to eliminate that debt. The crisis context just makes the urgency more concrete. The window before a crisis fully materializes is the most useful window you will ever have for attacking variable rate debt. Not after oil prices spike and inflation rises and your monthly budget is already under pressure. Now, while the signal is visible, but the full impact has not hit your grocery bill yet. The approach is simple. Keep paying the minimum on every debt you hold and direct every additional dollar of discretionary income toward the single highest interest rate debt first. When that one is eliminated, the money that was going to minimums rolls forward to the next one. Buffett calls the concept of stacking advantages the snowball. It applies to debt elimination in exact reverse. You are unwinding the snowball of interest that is rolling downhill at your expense. Not every country in the world has the same relationship with the Strait of Hormuz. The United States, since around 2018, has been the world's largest oil producer, a position it has maintained and grown since then through shale production. Domestic production does not eliminate American dependence on global oil prices, but it significantly reduces the direct supply exposure. Europe imports meaningfully from Norway, the North Sea, and increasingly from the United States in the form of liquefied natural gas. But Asia, Japan, South Korea, China, India runs on Persian Gulf oil. Japan imports approximately 90% of its energy needs, and a substantial portion of that flows through the Strait of Hormuz. South Korea, similar story. China, the world's second-largest economy, depends heavily on that corridor. A strait disruption does not hit all equity markets equally. Asian markets have a fundamentally higher direct exposure to this specific risk than U.S. domestic markets do. Most people with diversified investment portfolios have no idea what percentage of their holdings is concentrated in Asia-Pacific exposure. The reason is that most people buy a fund by its name: Total International, Emerging Markets, World Index, and never look inside at the geographic breakdown. A Total International stock fund can easily have 30 to 40% of its holdings in Asia-Pacific companies. In a scenario where a Strait of Hormuz disruption hits Asian economies particularly hard, those funds carry a higher direct exposure than a US-focused domestic equity fund. This is not a reason to panic or sell everything international. It is a reason to know what you own. Open the fact sheet for your international funds. Look at the geographic allocation. Decide deliberately whether you want that level of Asia-Pacific concentration during a Persian Gulf crisis window. Buffett has consistently kept the overwhelming majority of Berkshire's assets in American businesses, not because international markets are inferior or unworthy of investment, because he invests within his circle of competence, the businesses, the legal environments, the regulatory frameworks, and the consumer behaviors that he understands deeply. He has said directly that he has a significant competitive edge in analyzing American businesses and minimal edge in analyzing businesses in markets he knows less well. That focus also happens to serve as a natural hedge against geopolitical risk concentrated in regions far from America's domestic energy infrastructure. Understanding the geographic shape of your portfolio is the first step to knowing where your exposure actually sits. There is a category of investment that most retail investors walk right past because it sounds boring, which is exactly why it is worth understanding. Midstream energy companies. These are the businesses that move oil and natural gas through pipelines, storage terminals, and processing facilities. And here is the detail that changes everything about how you think about them. They do not primarily make money from the price of oil. They make money from the volume of oil moving through their infrastructure. They charge a fee per unit of throughput, per barrel, per cubic foot of gas. Think of it like owning a toll highway instead of a car. You do not care what the cars are worth or whether they are expensive or cheap. You care that traffic is moving. As long as oil needs to get from one place to another, and it always does, the pipelines collecting that toll keep generating revenue. The historical performance of midstream infrastructure during oil shock events supports this framing. During the 2022 energy crisis triggered by the Ukraine-Russia conflict, when oil prices spiked dramatically and most of the broader market fell, midstream MLPs, master limited partnerships, a common structure for pipeline companies, outperformed the general market substantially. The same pattern appeared during the 2014 to 2016 period of oil market volatility and during previous Persian Gulf tension windows. These are not high-growth, excitement-driven investments. They pay regular dividends, sometimes substantial ones. They move slowly. They rarely make headlines. That combination of low drama and consistent income is precisely what Buffett has built much of Berkshire's core around. His BNSF railway acquisition follows the same logic. Own the infrastructure the economy cannot function without. Collect the fee, hold for decades. If the structure of individual master limited partnerships feels complex, and the tax treatment of MLPs, with their K1 tax forms and pass-through income, genuinely is more complicated than a standard stock, there's a simpler path. Exchange-traded funds that track the midstream MLP sector broadly can provide similar exposure without the individual entity complexity. The fund handles the underlying structure. You receive the net exposure. This is not investment advice, and no specific fund is being recommended here. The point is that this category exists. It behaves differently from general energy stocks, and understanding how it functions is part of building a complete picture of how to position for a sustained energy supply risk. Beyond midstream specifically, a broader diversified commodity allocation can serve as an additional buffer. Commodity tracking ETFs that cover a basket of energy, agricultural, and industrial materials tend to move in correlation with oil prices during inflationary periods. When oil rises, transportation costs for agricultural products rise, which lifts food commodity prices. When energy prices lift, industrial materials that require energy-intensive production tend to follow. A small, deliberate allocation to diversified commodities, similar in size to the gold and silver allocation, functions as a broader shock absorber for the specific economic environment that an oil supply disruption creates. Pay attention to this, because it is the move that determines whether the other 6 moves actually matter. The most financially destructive response to a geopolitical crisis is not failing to buy gold. It is not having too much international exposure. It is panic selling, liquidating long-term investments at the bottom of a fear-driven price drop, turning what was a temporary paper loss into a permanent real one. And then watching the market recover from the sidelines, too anxious to get back in, because every possible entry point still feels dangerous. By the time it feels safe to reinvest, most of the recovery has already happened. You sold during the fear. You bought back during the confidence. You transferred your wealth to the people who did the opposite. And I know what some of you are thinking right now. You are thinking, but this time could be different. This time the risk is real. This time the geopolitical situation is genuinely serious. And you are right that it is serious. But consider the historical record on "this time is different" as a financial thesis. People said it in 1973. They said it in 1990. They said it after September 11th. They said it in 2008. Every single time, investors who panic sold their diversified long-term positions and waited for clarity ended up buying back higher than they sold after missing substantial portions of the recovery. The crisis was real every single time. The permanent impairment of long-term diversified portfolios did not occur. The impairment occurred specifically for the people who acted on fear. The stock market is designed to transfer money from the active to the patient. Buffett said that in 2004. But it applied in 1974, it applies today, and it will apply in 2036. The Iran crisis is real. The supply risk is real. The economic transmission mechanism is real. Oil into inflation, into rates, into your budget. But Amazon's logistics network does not become worthless because the Strait of Hormuz is contested. The S&P 500 index fund you hold does not permanently lose its value because tanker insurance rates went up. The 7 moves in this video address specific legitimate risks in specific targeted ways. Everything outside of those targeted adjustments, the diversified long-term core of your portfolio, should stay exactly where it is. Here is what the action actually looks like in practical terms. Review your emergency fund. Is it 6 months of real expenses held in something that earns a real return? If not, that is the first move. Look at your portfolio allocation. Do you have any meaningful energy exposure? If not, that is the second consideration. Check your variable rate debt. Is there a balance you could attack in the next 90 days before rates potentially climb further? Third consideration. Look at your international fund holdings. Do you know how much of it is Asia-Pacific concentrated? Fourth. Beyond those specific adjustments, sit with it. Watch the news without letting the news run your financial decisions. Crisis watching and crisis managing are 2 different activities. The first generates anxiety, the second generates results. Risk comes from not knowing what you are doing. Buffett said that too, and that quote is the entire purpose of this video applied to the specific moment we are in. When you do not understand why the Strait of Hormuz matters for your grocery bill, you are vulnerable to panic because you cannot distinguish meaningful risk from noise. When you understand the mechanism, the choke point, the oil price transmission, the inflation feedback loop, the sectors that benefit and those that suffer, you are no longer just a person watching the news. You have a framework. Frameworks do not panic. They execute. Over the next 12 months, there are going to be 2 kinds of people watching this situation develop. The first group is going to react to every new headline, every oil price movement, every market dip, every expert prediction, buying and selling based on anxiety, moving money based on the last thing they read rather than any coherent framework, exhausting their decision-making capacity on information that changes every 48 hours. The second group already knows the shape of their financial position. Their emergency fund is solid, their debt load is manageable, their energy and inflation exposure is intentional. Their long-term investments are exactly where they should be. They are not watching the news, hoping for calm. They are already positioned for the range of outcomes the storm might produce. Buffett built Berkshire Hathaway around what he calls a financial fortress, a structure so liquid, so sound, and so deliberately designed that external chaos creates opportunity instead of threat. You are not Berkshire Hathaway. But the principle scales to any level. Your 6-month emergency fund is the fortress wall. Low consumer debt is the moat, the thing that keeps external pressure from getting inside the gates. A small, deliberate energy and inflation hedge is the watchtower that sees the threat early and adjusts the position. And patience with your long-term investments, the discipline to not react to every market tremor, is not passivity. It is the strategic posture that has built more wealth over more decades for more investors than any other approach in the history of the market. The information is here. What you do with it is your call. Buffett has always said that investing is simple but not easy. The simple part is these 7 moves. The not easy part is executing them when the headlines are loud. The anxiety is real, and every financial commentator is offering a different prediction. But you now understand the mechanism. You understand why the strait matters, what Buffett has done in previous crises, and which specific adjustments your position might actually need. That matters more than it might seem in this moment. Stay curious, stay informed. If you stayed until the end, write in the comments, "I am prepared." There is another video ready for you on screen right now. The next step in understanding how money really works in a world like this. Thank you for watching. We will see you in the next one.